Imagine owning like a piece of these massive, really iconic properties, those huge shopping malls you wander through, or the giant office towers that basically make a city's skyline, or even those super important data centers that keep the whole digital world running. Now, picture getting income from these huge assets, kind of like getting dividends from stocks, right? But without all the headaches. No chasing rent, no fixing leaky roofs at 3 in the morning, no dealing with complicated mortgages yourself. That's the really tempting idea behind real estate investment trusts or REITs. So in this deep dive, we're going to really get into the world of REITs. We'll unpack what they actually are, look at how they came about. It's kind of a quirky origin story involving a specific U.S. law aimed at making big real estate deals accessible to regular people. We'll explore the different ways they work, the potential upsides. Yeah, that passive income thing is definitely a big draw, but just as important, we have to talk about the risks, the complexities, the tax stuff you really need to get your head around before you even think about investing.
Yeah, definitely. We'll break down the main types, based on the kind of real estate you're into and also how you actually buy and sell them, because that makes a huge difference in terms of like liquidity and how easy it is to get involved. We'll dive into their unique tax rules, how they skip corporate tax, and how things like return of capital can affect your real after-tax return. And yeah, we'll even take a peek at some of those super high yield REITs that pop up, but with a massive flashing warning sign attached. We're pulling this all together from sources like Sure Dividend, Investopedia, the Corporate Finance Institute, First National Realty Partners, and Franklin Templeton.
Right. Our mission today is pretty simple. Boil down the key info from these sources to give you a really clear, solid understanding of this unique investment type. By the end, you should have a much better sense of whether REITs might, fit into your own investment plan. Okay, let's get into it. Let's really peel back the layers here.
Absolutely. So first things first, what is a REIT? Fundamentally, it's a term you hear a lot. What does it actually mean for an investor?
Yeah, let's strip it right down. What are we really buying?
Okay, at the most basic level, a REIT real estate investment trust. It's basically just a company whose main business is owning, operating, or maybe financing real estate that produces income. The key word is company. When you buy into a REIT, you're buying shares of that company, not like a tiny piece of the actual building deed. It lets you get exposure to these huge properties, stuff you couldn't normally buy solo, but in a way that feels more like buying regular stocks.
And this whole setup, this company for real estate idea, it wasn't just something that happened organically, right? It was specifically created by law.
Yeah, that's actually one of the really interesting bits. REITs were specifically created by U.S. law way back in 1960. And funnily enough, it wasn't some big standalone real estate act. It was actually an amendment tacked onto something called the Cigar Excise Tax Extension.
The cigar excise tax extension, that sounds like some kind of historical trivia question.
It really does, doesn't it? But tucked away in that tax law was this amendment with a very specific goal. Make investing in large-scale, income-producing real estate something the average person could actually do. Before 1960, if you wanted a piece of a big office building or a shopping mall, your options were pretty limited. You needed a lot of cash, you needed connections, or maybe you could get into private partnerships, but those weren't open to everyone. Lawmakers basically wanted to level the playing field. They wanted to create something for real estate that worked kind of like mutual funds do for stocks, let regular folks pool their money together and get the benefits of professional management and diversification, but in the real estate world.
So it was actually a deliberate policy move to sort of democratize access to big real estate.
Exactly. And, well, it certainly worked. If you look at the scale of REITs today, it's just massive. As of 2024, REITs collectively own something like over $4 trillion in U.S. real estate assets. And the publicly traded ones, the ones on the stock exchanges, they own around $2.5 trillion of that, with a market cap over $1.3 trillion. They're a huge part of the modern real estate market.
Wow, $4 trillion. That definitely shows how big they've become. Okay, so they're companies owning real estate set up by law. How do they actually, make money? And how does that get back to the investors like me?
Right. So the basic model is pooling capital. Investors like you buy shares. The REIT takes all that money and uses it to buy, manage, maybe develop properties that generate income. Their main way of making money is just collecting rent from the tenants in those properties. So an office REIT gets rent from businesses, a retail REIT gets rent from stores, a residential REIT gets rent from apartment dwellers, and so on.
So it still boils down to rent collection, but I don't have to deal with the hassle.
Precisely. You get the potential income stream from the rent, but you don't have to worry about finding tenants, fixing toilets, or, heaven forbid, dealing with evictions. The REIT company itself handles all that management, the maintenance, everything. You just own a slice of that big, professionally run portfolio.
Okay, and how does that income flow back to shareholders? This is where that famous 90% rule comes in, isn't it? That seems really central to what REITs are.
It absolutely is. It's really the cornerstone of the whole REIT structure, and it's a huge reason why income investors find them attractive. See, to qualify as a REIT under the law, and this is key to get that special tax treatment we'll talk more about, the company has to distribute at least 90% of its taxable income each year to its shareholders as dividends.
90%.
Yeah.
That's a massive chunk of their earnings they're forced to pay out. Why make it so high?
It's basically the deal they make with the government. In return for paying out almost all their taxable income, REITs typically get a huge tax break. They generally don't pay corporate income tax on the income they distribute. This avoids that whole double taxation issue you see with regular companies, where the company pays tax on its profits and then shareholders pay tax again on the dividends they receive from those profits. With the REIT, the income is usually taxed just once when the shareholder receives the dividend.
Ah, I see. So those high dividend yields REITs are known for aren't just them being generous. It's actually built into the rules for them to keep their special tax status. It's like a pass-through system.
Exactly. That distribution requirement is fundamental. It drives the income potential, though, of course, the share price can go up or down too, affecting your total return.
Okay, that makes sense for the basic setup. But real estate is such a broad term, right? And you mentioned how you invest can differ too. Let's maybe dig into the different kinds of REITs, starting with what they actually invest in.
Right, they're definitely not all the same. What they invest in really shapes how they perform and what risks they face. The two big categories, based on what they own or finance, are equity REITs and mortgage REITs, often called MANs.
Equity REITs seem like the main type based on our sources.
Yeah, by far. Equity REITs make up something like 96% of the U.S. REIT market assets as of 2023. These are the ones that fit that classic definition. They actually own and operate the physical buildings that produce income.
So they're the actual landlords, just on a corporate scale.
Pretty much. Their main income source, like we said, is collecting rent from tenants. They might also make money sometimes by developing new properties or selling existing ones for a profit, but rent is really the core engine.
And the types of properties they own, it's a huge variety.
Oh, absolutely. You can find equity REITs that focus just on office buildings. Others just do retail centers. And even there, there's a difference between a big regional shopping mall and maybe a smaller shopping center anchored by a grocery store. The performance can vary a lot depending on what people are buying and how. Then you've got residential REITs with apartment buildings, industrial REITs owning those massive warehouses for e-commerce logistics, healthcare REITs with medical buildings and hospitals, self-storage places, hotels, resorts, even infrastructure REITs owning things like data centers, cell towers, fiber optic cables. A lot of them specialize in just one sector, really build expertise there. But some are more diversified across different property types.
That specialization really matters, doesn't it? Investing in an office REIT must be totally different from an industrial one. Your success is tied to that specific sector's health.
Completely. Sector risk is huge for equity REITs. The whole work from home trend, that's been a major headwind for office REITs. But the boom in online shopping, that's been great for industrial REITs needing warehouse space. Generally speaking, equity REITs have often done better when interest rates are low, makes borrowing cheaper for buying properties and when property values are going up. But honestly, the specific sector trends often outweigh those broader factors.
Okay, so equity REITs own the buildings. What about mortgage REITs or MITES? The name suggests they don't actually own property.
Correct. They're a totally different beast, much smaller part of the market, maybe around 4%. They don't own the physical real estate. Instead, they provide the financing for it. How? Well, mostly by buying or sometimes originating mortgage loans themselves, or more commonly, by investing in bundles of mortgages called mortgage-backed securities, or MBS.
Mortgage-backed securities, weren't those the things that got talked about a lot during the 2008 financial crisis?
Yes. They were definitely central to that whole situation, although the market and regulations have changed quite a bit since then. But essentially, an MBS is like a package containing lots of different mortgage loans. When you invest in an MBS, you're buying the right to receive the cash flows, the principal and interest payments, from all those pooled mortgages. So MBRITEs invest heavily in these pools.
So their income isn't from rent, it's from interest payments.
Exactly. Their profit comes mainly from the net interest margin. That's the difference, or the spread, between the interest they earn on the mortgages or MBS they hold and the cost of the money they borrowed to buy those assets in the first place. They make money on that spread.
And they can focus on home loans or loans for commercial buildings?
Yeah, they can specialize in residential MBS, commercial MBS, or sometimes they hold a mix of both.
Okay, you mentioned equity REITs generally like lower interest rates. How do MREITs react to rate changes? It seems like that would be super critical for them given their business is all about interest spreads.
Right, this one's a bit more complex and can even seem contradictory. Our sources point out that sometimes MREITs can actually do better when rates are rising because the new mortgages or MBS they buy will have higher interest rates, potentially boosting their income. However, and this is big, however, rapidly rising rates can also be, as one source put it, a strong headwind. Why? Because the interest rate they have to pay on the money they borrow to buy those assets also goes up. If their borrowing costs rise faster or higher than the yield they're getting on their assets, that net interest margin, their profit spread, gets squeezed. Really squeezed.
I see the conflict. Higher rates could mean higher potential future income, but also higher current borrowing costs. So it's a tricky balancing act for them.
Very tricky. Both types, equity and mortgage, are really sensitive to interest rates. But how it affects them, and sometimes even the direction, can be different. It's definitely a key risk factor you have to understand for any REIT.
And there used to be hybrid REITs that mixed both strategies.
Yeah, they did exist, investing in both physical properties and mortgages. But the sources suggest they're pretty uncommon now. Apparently, their market share basically vanished after the 2007-2008 crisis. Seems like the market prefers the more focused approaches these days.
Okay, so that covers the types based on what they invest in. But you also mentioned how you invest in them matters a lot. The trading status makes a big difference.
Oh, absolutely. It fundamentally changes things for the investor. How easy it is to get in and out, how much information you can find, how liquid your investment is. There are basically three main categories here: publicly traded REITs, public non-listed REITs or PNLRs, and private REITs.
Let's start with the ones most people are likely to encounter, publicly traded REITs.
Right. These are the ones most people mean when they just say REITs. They're registered with the SEC, the Securities and Exchange Commission, the main U.S. market regulator. And the crucial part is their shares trade on major stock exchanges, like the New York Stock Exchange or NASDAQ.
So buying them is basically just like buying shares of, say, Google or Ford.
Pretty much, yeah. If you have a regular brokerage account, you can usually just buy shares of a publicly traded REIT like any other stock. The minimum investment is just whatever one share costs, so they're super accessible. Prologis, that big industrial REIT, is an example of one you'd find on the NYSE.
And being on the exchange and registered with the SEC means there's a lot more transparency, right?
Way more transparency than the other types. Because they're regulated and traded publicly, they have strict reporting rules. They have to file regular reports, including audited financials, and anyone can access those through the SEC's EDGAR database online. Plus, you get tons of performance data, news coverage, analyst research, all the stuff you expect for a public company.
And the killer advantage compared to actually owning a building, liquidity.
Yeah, this is probably the single biggest plus for publicly traded REITs. They are highly liquid. You can usually buy or sell shares pretty quickly and easily during market hours at whatever the current market price is. That's a world away from trying to sell an actual building, which can take months.
Okay, so easy access, lots of info, easy to sell. What about these public non-listed REITs, the PNLRs? They sound different.
They are, and they bring in more complexity and way less liquidity.
Yeah.
So PNLRs are still registered with the SEC. That means they have some oversight and reporting requirements.
Yeah.
But the key difference is right in the name. Their shares do not trade on public stock exchanges.
So how do you even buy them then?
Usually you have to buy shares directly from the REIT company itself, or maybe through a network of specific broker-dealers who are handling the offering.
And if they don't trade, liquidity must be a problem, right? How do you sell?
That's the big drawback. PNLRs are much, much less liquid than the publicly traded ones. You can't just click sell in your brokerage account. They might offer some kind of limited share repurchase program, but these often have restrictions, limits on how much they'll buy back, or they can even be suspended altogether. Getting your money out can be really difficult and might take a long time.
Okay, so less info than public ones and harder to sell. And then there are private REITs. Sounds even more exclusive and maybe less regulated.
That's exactly right. Private REITs are the least accessible and have the least amount of regulatory oversight. They're generally exempt from having to register with the SEC. That means no trading on exchanges, and they don't have to file those regular audited financial reports with the SEC that Public companies do.
Exempt from SEC registration, so who can even invest in these? Not just anyone, I assume.
Definitely not. Because they're exempt, they can generally only be sold to what the SEC calls qualified institutional investors. That's the big pension funds, university endowments, that kind of thing, and also accredited investors.
Accredited investors, those
Yeah.
are the folks who meet certain high income or net worth thresholds, right?
Exactly. Typically, you need an income over $200,000 a year for the last couple of years, or $300,000 with a spouse, or a net worth over $1 million, not counting your main home. Plus, the minimum amount you have to invest in a private REIT is often pretty hefty. It could be $10,000, $100,000, or even way more.
Okay, clearly not for the average investor starting out, and information must be scarce.
Very scarce, publicly speaking. Since they aren't registered and don't trade, there's almost no public performance data or independent analysis out there. The information mostly comes from reports the REIT sends directly to its own investors.
And liquidity. I'm guessing it's the worst of the bunch.
Extremely illiquid. Private REITs offer the least liquidity, by far. Getting out is usually very tough. You might have to rely on redemption programs that are limited or entirely at the REIT's discretion, or you could be locked in for years. Our sources mention potentially up to 7 years for some non-traded REITs, which could include both PNLRs and private ones before you might see your money back through some kind of sale or liquidation event.
7 years, wow. That's a serious lockup period. This difference between public, non-listed, and private seems incredibly important for people to grasp.
It's absolutely critical. The sources really stress that non-traded and private REITs just come with higher inherent risks because of that severe illiquidity, the lack of public information compared to traded ones, and often they have higher fees too. The SEC has even put out warnings about potential fraud, especially with less regulated private REITs. Always verify if something claims to be registered using the SEC's EDGAR system if you're looking at anything non-public.
Okay, that's a great breakdown of the different flavors. We know what they are, how they make money, the different types. Let's flip the coin now. Let's talk about the upside. What makes REITs attractive? Why do people invest in them?
All right, let's dig into the potential benefits, the reasons why REITs are a popular choice for a lot of investors.
We kind of touched on it, but that accessibility, especially compared to buying property directly, seems huge.
It really is. For the publicly traded ones, the accessibility is just fantastic compared to traditional real estate investing. You don't need a fortune to get a piece of a high-quality, diversified portfolio of commercial properties. You can just buy shares in your brokerage account, maybe starting with just $100 or whatever one share costs. It really did break down barriers for ordinary investors wanting real estate exposure.
And diversification is always talked about as a benefit of real estate. How do REITs fit into that picture?
They offer diversification in a couple of really useful ways. First, just by buying one diversified REIT or a REIT fund, you can instantly spread your investment across maybe different types of properties or different parts of the country. So you're not betting everything on one building or one location. Second, and this is really valuable for your overall portfolio, REIT returns often don't move perfectly in sync with the broader stock and bond markets. They have what's called a relatively low correlation. That means adding REITs to a mix of stocks and bonds can potentially smooth out the ride a bit, maybe lower the overall risk, because they react differently to economic changes. Plus, sources mention they can potentially act as a hedge against inflation, since rents and property values tend to rise with inflation over the long run.
That low correlation is a big deal for building a balanced portfolio. And then, of course, the income. Those potentially high dividends due to the 90% rule.
That's definitely a main draw, especially for people focused on generating income. Because they have to pay out 90% of their taxable income, REITs often have dividend yields that are quite attractive, frequently higher than many regular stocks. It offers a potential stream of relatively steady passive income from real estate delivered right to your account as cash. No landlord duties required.
And how have they actually performed over time?
Well, looking back historically, REITs have put up pretty competitive total returns. That's the dividends plus any increase in the share price. NAREIT, which is the main industry association for REITs, says their FTSE NAREIT All Equity REITs Index had an average annual total return of about 9.09% from 1972 all the way through 2022.
A 9% average annual return over 50 years. That's definitely holding its own against other major asset classes.
It is. And there was another study mentioned by SAM Benchmarking looking at institutional investments from 1998 to 2022. It found that REITs actually outperformed private real estate on average during that period, 9.7% annual return for REITs versus 7.7% for private real estate. That same study also found that REITs, on average, did better than the broader stock market during and right after the last 6 recessions.
Hmm. Outperforming private real estate and stocks during recessions. That suggests they might have some defensive qualities in tough times.
Yeah, it points to their potential strategic role in a portfolio. Another plus we mentioned is that tax efficiency at the company level. Since they pass most income through, they avoid paying corporate tax themselves, meaning more of the property income could potentially reach shareholders.
And some people just like the idea that it's backed by something physical, right? Bricks and mortar.
Exactly, that tangibility factor. In a world where a lot of investments feel abstract, knowing your money is ultimately tied to actual physical buildings, warehouses, apartments, shopping centers, gives some investors a sense of stability. It can make it easier to ride out those short-term market swings.
And we can't forget the liquidity advantage, at least for the publicly traded ones.
Yeah, huge practical benefit. It's not like cash, obviously, but being able to sell your shares relatively quickly on an exchange is a massive difference compared to the months it can take to sell a physical property.
And finally, just getting access to those huge commercial properties in the first place.
That's a big one, too. For most individual investors, owning even a tiny fraction of a major downtown office tower or a giant logistics center near a port is just impossible on their own. REITs give you that fractional ownership, that access to institutional quality commercial real estate.
Okay, so quite a list of potential positives. Easy access, diversification, income potential, solid historical returns, tax efficiency for the company, tangible assets, liquidity for the public ones. But every investment has its risks. What are the major downsides, the things people absolutely have to be aware of?
Right, it's crucial to go in with your eyes open. No free lunch in investing, and REITs definitely have their own set of risks and disadvantages.
Let's start with the flip side of those nice high dividends, how they're taxed.
Yes, this is a really important one. While the dividends look good on paper, how they're taxed can be a big negative if you hold REITs in a regular taxable brokerage account. Unlike dividends from many common stocks, which often qualify for lower capital gains tax rates, most REIT dividends are typically taxed as ordinary income. That means they're taxed at your regular income tax rate, which can be much higher, especially for people in higher tax brackets. A big chunk of that dividend can go straight to Uncle Sam, cutting down your actual take-home return.
So that juicy yield you see advertised might not be quite as juicy after taxes compared to other dividend stocks.
Exactly. You need to calculate the after-tax amount. Another major risk, one we touched on, is that sensitivity to interest rates.
How does that actually play out for REITs?
Well, interest rate changes really ripple through the REIT world. When rates go up, it costs REITs more to borrow money, and most use debt or leverage to buy properties. Higher interest payments squeeze their profits and cash flow, which can put pressure on their ability to pay dividends or buy new properties. We saw that source mention rising rates as a strong headwind for Cranks, the mortgage REIT, because it hits their borrowing costs and margins. Rising rates can also make other income investments, like bonds, look relatively more attractive, potentially drawing investors away from REITs and maybe even pushing down property values.
Okay, so higher borrowing costs for them and more competition for investor money. That makes sense.
Yep, and it affects both equity and mortgage REITs, just maybe in slightly different ways, but it's a key risk across the board. Also, like any stock, publicly traded REITs face general market risk.
You mean their prices can just fall because the whole stock market is having a bad day?
Precisely. Since they trade on exchanges, their share prices get pushed around by overall market sentiment, economic worries, recessions, things that affect all stocks. Even if the REIT's actual properties are doing fine, the share price can still drop just because the market's down, meaning you might have to sell for less than you paid. Our sources mention it's tough to diversify away this kind of broad market risk.
And then the risk tied to the specific type of property they own.
Absolutely critical. Sector-specific risk. Since so many REITs specialize, their fortunes are tied to what's happening in that particular niche of the real estate world. If you own a retail REIT, you're exposed to everything impacting physical stores, e-commerce trends, changing shopping habits, maybe tenant bankruptcies. Invest in an office REIT, and you're exposed to the whole remote work shift, potentially lowering demand for office space.
Didn't the sources mention an example of this with that cannabis REIT, IPR?
Exactly. Innovative Industrial Properties, IPR, focuses on properties for the cannabis industry. The Q1 2025 update mentioned its revenue and a key cash flow metric, ARO, were down compared to the previous year, specifically because of issues with tenants, including some not paying rent or needing deferrals. That's a perfect illustration. Problems in the cannabis sector directly hurt the REIT that serves it, impacting its income and dividend potential. You really have to understand the industry the REIT is in, not just the REIT itself.
Makes that need for sector research really clear. What about fees? Can they eat into returns significantly?
Fees are definitely something to watch, especially with the non-traded types. Public, non-listed, and private REITs can have really high upfront sales commissions. The sources mentioned numbers like 8% or even up to 15% of your investment just vanishing right off the top. That's a huge hurdle to overcome before you can start making money. Plus, they often have ongoing management fees and sometimes complicated structures where the managers take a bigger cut of the profits. All these fees directly reduce your return. Even the publicly traded ones have management fees baked into their operating costs, which affects their overall performance.
And that liquidity risk for the non-traded and private ones, that sounds like a major disadvantage.
It cannot be overstated. For PNLRs and private REITs, the lack of liquidity is a fundamental risk. You might simply be unable to get your money out when you need it for an emergency, another opportunity, whatever. You could be stuck for years, potentially up to 7 years, according to the sources, or maybe forced to sell back to the REIT through a limited program at a steep discount. It's just not like owning a regular stock or ETF you can sell any market day.
7 years is a really long time to have your money tied up, potentially.
It's a serious commitment. Requires really thinking about your own timeline and need for access to funds. Another big risk is leverage.
Using borrowed money, right?
Correct. REITs, especially equity REITs buying big properties, often use a lot of debt or leverage. It's like using a mortgage on a house, lets you control a bigger asset with less of your own cash. When things go well and property values rise, leverage juices up your returns. But it's a double-edged sword. Leverage also increases your expenses, those interest payments. And if property values fall or income drops, leverage magnifies your losses on the equity you put in. Imagine a REIT buys a $100 million property using $50 million of its own cash and $50 million in debt. If that property's value drops just 10%, that's $10 million, it wipes out 20% of the REIT's initial $50 million investment. Checking a REIT's debt levels, like its debt-to-equity ratio, is crucial.
So leverage cuts both ways, makes good times better, bad times worse. And lastly, compared to maybe some fast-growing tech companies, REITs might not offer as much potential for huge share price growth.
That's generally true, and it flows from that 90% distribution rule. Because they have to pay out so much of their taxable income as dividends, they only keep a relatively small slice, 10% or less, of taxable income to reinvest back into the business, like for buying more properties or developing new ones. This naturally limits how much they can grow just by reinvesting their own earnings, compared to companies that keep more profits to fuel expansion. Growth for REITs often comes more from raising new capital, buying more properties, and increasing rents.
And that SEC warning about potential fraud, especially with the unregistered private REITs, is definitely a risk to keep in mind.
Absolutely. Less oversight and transparency just creates more opportunity for things to go wrong, whether it's mismanagement or actual fraud. Checking registration on SEC Edger is a basic but vital step.
Okay, that's a really comprehensive look at the potential pitfalls, from tricky taxes on dividends, sensitivity to rates and markets, sector woes, high fees, getting stuck in illiquid investments, the dangers of leverage, maybe slower growth, and even fraud. Definitely not a simple buy and forget investment, especially if you go beyond the plain vanilla public ones. Let's maybe circle back to the taxes for a minute because they sound particularly unique and impactful for REITs.
Good idea. Yeah, the tax side is really important to understand, especially if you're holding them outside of a retirement account.
So we established rule number 1. Most REIT dividends get taxed as ordinary income, usually at a higher rate than qualified stock dividends.
Yes, that's the baseline. That nice dividend payment gets treated like salary or interest income, taxed at your top marginal rate.
But there was that tax law change recently that provided a bit of a break, temporarily at least.
That's right. The 2017 Tax Cuts and Jobs Act brought in something called the Qualified Business Income Deduction, or QBI deduction. For eligible taxpayers, this lets you deduct up to 20% of your qualified REIT dividends.
Can you walk through how that actually lowers the tax bill?
Sure. The source had a good example. Let's say you're in the highest federal bracket, 37%. Normally, your REIT dividend would be taxed at 37%. But with the 20% QBI deduction, you effectively only pay tax on 80% of the dividend. So your effective tax rate becomes 37% times 0.80, which is 29.6%. It brings the rate down significantly. You might still have the net investment income tax on top of that depending on your income, but the QBI deduction itself is a decent break.
Okay, 29.6% is definitely better than 37%. But you emphasize temporarily.
Yes, very important point. As the law stands now, that 20% QBI deduction is set to expire at the end of 2025. Congress would have to pass new legislation to keep it going, so you can't count on that benefit forever based on current law.
Good to know for planning. Now, what about this other thing you mentioned, return of capital, or ROC? How does that fit into the tax picture?
Return of capital. This is a really interesting and potentially beneficial quirk of REIT taxation. ROC happens when a REIT distributes more cash to shareholders than it reports as taxable income for that period.
Wait, how can they pay out more cash than they earned in taxable income? That sounds counterintuitive.
It happens mainly because of large non-cash expenses, and the biggest one is depreciation. You see, buildings wear out over time, and tax rules let real estate owners deduct a certain amount each year for this wear and tear. Depreciation is just an accounting entry. It reduces the REIT's taxable income on paper, but it doesn't actually reduce the cash coming in from tenants paying rent. So the REIT might collect, say, $1 million in rent, cash, but then takes a $300,000 depreciation deduction, non-cash. Its taxable income is only $700,000, but it still has the full $1 million in cash available. When it distributes that extra $300,000 that was shielded from tax by depreciation, that portion is often classified as return of capital.
I see. So the cash payout exceeds the taxable income because of those non-cash deductions like depreciation. And that excess cash payout gets labeled ROC.
That's the gist of it. That part of your dividend is considered a return of your original investment money, not a distribution of current profits.
And how is ROC taxed? Is it different?
Yes, and this is the key benefit. Generally, the ROC portion of your distribution is not taxed in the year you receive it. You get that cash, tax-free, right now.
Tax-free cash sounds great. What's the catch?
The catch is that it's tax deferral, not tax elimination. That ROC amount reduces your cost basis in your REIT shares. Your cost basis is basically what you originally paid, and it's used to figure out your profit or loss when you sell. By lowering your cost basis, ROC means that when you eventually do sell the shares, your taxable capital gain will be larger or your loss smaller than it would have been otherwise. So you pay the tax later when you sell, and it'll likely be taxed at capital gains rates then, but you do eventually pay tax on that deferred amount.
Okay. So no tax now, but a bigger tax bill later when you sell. But it definitely boosts your current after-tax cash flow. Can we use that example from the source to see the impact?
Yeah, let's run those numbers. Say you invested $100,000 in a REIT paying a 5% dividend, so $5,000 a year. And let's use that effective tax rate of 29.6%, 37% bracket minus a 20% QBI. If none of the $5,000 dividend is ROC, the whole thing is taxed at 29.6%. Tax owed, $4,480. Your after-tax cash is $3,520. Effective tax rate on the whole dividend, 29.6%. Now, let's say half, $2,540. That $2,500 is tax-free now. The other $2,500 is taxed at 29.6%. Tax owed is only $740. Your total cash received is still $5,000 minus $740 tax, so you keep $4,260 after tax. The effective tax rate on that total $5,000 drops dramatically to just 14.8%, $740 tax, $5,000 total.
The example even showed if 75% was ROC, the effective rate dropped to 7.4%. If somehow 100% was ROC, your current tax is zero.
So knowing what percentage of a REIT's distribution is ROC versus taxable income is really important for understanding your true after-tax yield. Absolutely. It's a unique tax feature driven by things like depreciation, and it can make a big difference, even though it means a deferred tax liability down the road.
With all these tax wrinkles, does it make more sense to hold REITs in certain kinds of accounts?
Definitely. Given that ordinary income tax treatment for most dividends, many investors choose to hold their REIT investments, whether individual stocks or funds ETFs, inside tax-advantaged retirement accounts, things like traditional IRAs, Roth IRAs, 401ks. Inside these accounts, the dividends can generally grow tax-deferred in traditional accounts or potentially tax-free in Roth accounts. This helps sidestep that annual ordinary income tax hit, allowing the distributions to be reinvested and potentially compound more powerfully over time.
That makes a lot of sense, shelter the highly taxed dividends, but of course retirement accounts have their own rules about accessing the money before retirement age.
Exactly. It's always a trade-off between tax efficiency and immediate access. And look, taxes are complicated and personal. The sources strongly advise talking to a qualified tax professional to really understand how REIT taxes, QBI, ROC, and account types apply to your specific situation.
Crucial advice. Okay, let's shift focus to something that always grabs attention. High-yield REITs. You see these lists, yields in the double digits, sometimes even over 20%, like in one source. Sounds amazing for income investors, right?
It definitely catches the eye, that's for sure.
Yeah.
And yeah, that source listed yields up to 21.1%. But this is exactly where we need to wave the biggest red flag. The source itself was very clear. Abnormally high yields nearly always come with abnormally high risks.
So a super high yield isn't necessarily a green light. It's more like a flashing yellow or maybe even red light telling you to investigate carefully.
Precisely. The warning is stark. High yield, by itself, does not mean it's a good investment. Often, it's a signal that the market thinks there's a significant risk. The company won't be able to keep paying that dividend, or that the underlying business is in serious trouble. You absolutely have to look past the yield number and dig into the company's actual health.
What should you be looking for if you see one of these sky-high yields? What are the red flags in the fundamentals?
You got to put on your detective hat. Key questions. Is that dividend actually sustainable? Can they afford to pay it out from the cash they're generating? Look at their cash flow, their FFO or AFFO payout ratios. Why is the yield so high? Is it because the stock price is cratered? That's usually not a good sign. How good is the management team? What's their track record? And critically, check the balance sheet. How much debt are they carrying? High leverage makes any problem much worse. What are their real growth prospects? Or more importantly, can they even maintain their current income? A lot of times, the market pushes the yield high because it expects a dividend cut is coming or the business itself is deteriorating.
So the high yield might just be reflecting market fear, not a genuine opportunity.
Very often, yes. It's the market basically saying, we think this payout is risky, so we're demanding a higher yield to compensate for the chance it gets cut. Let's maybe use a couple of examples from that list in the source, not as picks, but just to illustrate these risks we've been talking about.
Okay, how about Orchid Island Capital, ORC? It had that massive 21.1% yield mentioned.
Right, ORC. The source identifies it as a mortgage REIT, focusing on residential MBS. So right away, you know it's an MREIT, subject to all that interest rate sensitivity and margin pressure we discussed. High yields are common for REITs because of their leverage, but that 21% is extreme, highlighting the volatility. The Q1 2025 notes mentioned net income down, net interest income up, book value per share declined. Those details show it's a complex financial play, very sensitive to rate moves and hedging. A falling book value could be a worrying sign about the underlying asset value eroding. That high yield likely reflects significant market concern about its stability.
And IIPR, the cannabis route we talked about earlier, with sector risk.
Yeah, Innovative Industrial Properties, IIPR, was listed at 13.8%. Perfect example of sector risk. The Q1 update mentioned lower revenue and cash flow because of problems with tenants in the cannabis industry not paying rent. So the high yield is almost certainly reflecting the market's worries about the stability and reliability of its rental income stream due to troubles in that specific sector.
And Chimera Investments, CIM, that was another mortgage-focused one, right?
Yeah, CIM listed at 11.2%, investing in mortgage assets. Its Q1 report showed sequential growth in core EPS, which sounds okay, but the source specifically flagged high interest rates as a strong headwind hitting margins. Again, reinforces that interest rate sensitivity for MACIDs. Even if one metric looks better short-term, the overall rate environment poses a big risk to future earnings and that dividend.
These examples really hammer home the point. You can't just see a 15% or 20% yield and jump in. You have to understand why it's so high and what risks the market is seeing.
Exactly. Looking at those specific performance numbers, changes in EPS, FFO, net income, book value gives clues, but interpreting them requires real work, way beyond just glancing at the yield.
So the takeaway is loud and clear. Treat super high yields with extreme skepticism. High yield equals high risk, demands deep homework.
Consider it a starting point for investigation, not a reason to buy. Ask the hard questions.
Okay, we've covered a ton today. What REITs are, their history, the types, the pros, the cons, the taxes, the high yield warnings. For someone listening who's absorbed all this and is thinking, all right, it's complicated, but maybe interesting, how would I even begin to explore this? Well, what are the practical first steps?
Okay, let's boil it down. For someone thinking about maybe dipping a toe in, keeping all those risks and types in mind.
First step is probably standard for any investing.
Yep, gotta have a place to invest. If you don't have one, you'll need to open a brokerage account. Lots of online and traditional options out there.
And based on everything we said about the different types, Where's the best place for a beginner to start looking?
Well, the discussion and the sources really point towards starting with publicly traded REITs. They're the easiest for regular investors to access. They offer the most transparency because they're SEC regulated and trade openly. And crucially, they have that liquidity you can generally buy and sell them much more easily than the non-listed or private kinds.
Makes sense. Stick to the most straightforward and liquid option first. What if you don't want to pick individual REITs right away? How do you get diversification easily?
That's where REIT mutual funds, or ETFs, exchange-traded funds, come in handy. They give you instant diversification. These funds pool investor money and buy shares in a whole bunch of different REITs, spreading your investment across various sectors or regions automatically. The sources mentioned examples like the T. Rowe Price Real Estate Fund, 2X, which is actively managed, or the Vanguard Real Estate ETF, VNQ, which passively tracks a broad U.S. real estate index. There are global options too, like the iShares Global REIT ETF.
So buying one fund or ETF gives you a piece of many different REITs, spreading the risk.
Exactly. It's a really good way to get broad exposure without having to research dozens of individual companies up front. You can choose active funds where managers pick the REITs, or passive index funds that just aim to match an index performance. And importantly, the fees for these funds, the expense ratios, have generally come down a lot over the years, making them pretty cost-effective.
And thinking back to the tax discussion, using those tax-advantaged accounts is worth considering.
Definitely worth exploring. Putting REIT funds, ETFs, or even individual publicly traded REITs into your IRA or 401k can really help manage the tax hit from those ordinary income dividends. Letting them compound tax-deferred or tax-free can make a big difference to your long-term growth.
Okay. And how much of a portfolio should someone consider putting into REITs?
The usual advice is start small, especially while you're learning. Maybe allocate just a small percentage, like 2% to 5% of your total portfolio, maybe using a diversified ETF. As you learn more and get comfortable, you could gradually increase it. Some sources suggest a typical diversified portfolio might have somewhere between 5% and 15% in real estate, often through REITs, but that's just a general guideline. The right amount for you depends entirely on your own financial goals, your overall portfolio mix, how much risk you're comfortable with, and your time horizon.
Start small, learn as you go, make it fit your own situation. And the most important thing throughout.
Research, research, research. Cannot stress this enough. Before buying any specific REIT or fund, do your homework. For an individual REIT, what properties do they actually own? Who are the main tenants? How good is the management? What does their debt situation look like? Leverage, HOBO. What's their dividend history? Is the payout safe? Understand the specific risks and trends in their real estate sector. For funds, what do they hold? What's the strategy? What are the fees? Keep an eye on the economy and news impacting the sectors they're in.
Basically, understand what you own, who runs it, and the world it lives in.
Absolutely. Due diligence is key.
Well, we've certainly taken a deep dive into real estate investment trusts today. We've seen how they offer this unique way to get into large-scale real estate without being a direct landlord. We looked at their history, that core 90% payout rule, the different flavors, equity versus mortgage, public versus private, and those crucial differences in liquidity and transparency. We covered the potential upsides like income and diversification, but also hammered home the really important risks and disadvantages, the taxes, the rate sensitivity, the sector issues, liquidity traps, and more. And we touched on those tempting but risky high yielders.
I think the main takeaway, the key lesson from all this, is that REITs can be a useful part of an investment strategy for the right person. They offer that real estate exposure, that income potential. But like any investment, they are complex. They have unique risks, tax rules, sector dependencies that you absolutely must understand before you jump in. Don't just chase yield. Don't just assume real estate is safe. Do the work. Understand the specific investment, make sure it truly fits your goals and your ability to handle the risks involved.
So here's something to chew on as you think about REITs. We know the way we use physical space is constantly changing, right? Remote work hitting offices, e-commerce reshaping retail, data centers becoming utterly essential. Given all that, how important will it become for REIT investors to stay intensely focused, not just on the individual company, but on the trends transforming specific real estate sectors? Maybe even more important than just looking at the financials.
That definitely wraps up our deep dive for today. We really hope this exploration has given you a clearer understanding of the REIT landscape and helps you think about them more strategically.
Thanks so much for joining us. We'll catch you on the next one.